So I'm going to work through problem E8-16 from the book. So if you want to follow along, just turn to that page. I think it's on page, let's see, page 459. So the first requirement is to journalize a couple of the transactions that they're presenting. So this first one on June 1st, High Performance Cell Phone sold $19,000 of merchandise to Andrew Trucking Company on account. So we are going to have an account receivable because it's sold on account, and we're going to have a sales revenue of $19,000. Let's check that. Oh, we got the comment here. Sold goods on account. There we go. Okay. So next we paid $7,000 on the account receivable. So, or rather, Andrew paid $7,000 on the account receivable. So we're going to collect cash, which is going to be a debit of $7,000. And since he's paying off part of his receivable, we have to reduce the receivable by the amount that he's paid off. And so this is collected cash on account. So let's check that. Okay. Next, on September 5th, High Performance wrote off its account receivable from Andrew. So our net receivable is $19,000 minus $7,000. So again, this is using the direct write-off method. So we are going to write off the bad debt expense directly. So how do we do that? We're going to have a bad debt expense of the remainder of the amount, which is $19,000 minus $7,000, which is $12,000. And we're basically saying that Andrew Trucking Company is not going to pay us this $12,000. We no longer want to have the account receivable on our balance sheet, so we're going to have to remove it by crediting this account receivable by $12,000. So we're going to put our memo as wrote off uncollectible amount. Okay. And now High Performance received a check for $12,000 with a note apologizing for the late payment. So basically we have the situation where we wrote off this account receivable, but in actuality we're actually going to collect it because this customer came through and is actually going to pay off what they owe us. So we have two steps to this. The first step is to reinstate this account receivable that we wrote off on September 5th. So how do we do that? We're first going to basically reverse this entry. So we're going to debit accounts receivable. We are going to credit our bad debt expense. So now, after doing this, we've basically undone this entry here. Now our accounting balances are going to be back to where it was at this point. And I'm reading the instructions very carefully. First, we journalize the reinstatement of Andrew's account, and we will journalize the second part of this in the next step. So let's check this. So reinstated previously written off account. Okay. And now in this next step, we're going to journalize the actual collection of the cash. So our cash balance is going to increase. We're going to have to clear his account receivable because he's not paid it off. And so collected cash on account. Okay. Okay, so now we've done that part of it. And again, I must emphasize that what we just did is the direct write-off method. The allowance method is going to have a different set of entries. But in this example, this problem, we've done the direct write-off method. So now this question is asking us, what are some limitations that high performance will encounter when using the direct write-off method? So in the first one, is saying that it's costly to implement. That's actually the opposite. The direct write-off method is easier to implement because you're not having to do any estimations like we have to do with the allowance method. So I don't agree with A. B, so B is saying that the direct write-off method adheres to the matching principle. I don't agree with that. I think that it's actually the opposite, that it does not adhere to the matching principle. So let's see what C has to say. C says that it will basically understate profits and net assets every year the method is used. I don't quite agree with that because in the year that you actually take the bad debt expense, you're going to be actually understating the profits for that year. I agree with that. But in the previous year, since you didn't account for that bad debt, you're actually overstating the profits in that year. So I don't agree with C. So let's see what D has to say. So I think the answer is D. We know that the direct write-off method does violate the matching principle because we want to match the bad debt expense with the period in which the related revenue was first introduced. So I think I'm going to go with D. Let's see. Okay, great.